Hello everyone, this is Jennifer. In this video, we're going to look into marginal costing problems and explanations. So basically, what is marginal costing? Okay, so marginal costing is a technique of ascertaining cost used in any particular method of costing by differentiating between fixed and variable cost. So what is fixed and variable cost? So fixed cost is one which remains unchanged in total amount over a wide range of production level. So what either the production is to the maximum level or to the minimum level, the fixed cost will never change, or the cost which doesn't change irrespective what the production level is known as fixed cost. So what are the examples of fixed cost? Example could be building rent, salaries of permanent staffs, etc. And what is variable cost? So variable cost per unit remains constant while the total amount of variable cost changes in direct proportion to changes in the level of production, meaning to tell depending on the level of production it changes the total variable cost, but for per unit the variable cost will remain fixed. Okay, so what are the examples of variable cost? Is raw material consumed. So for example, how much of raw material consumed depends on how much of production happens. The variable cost fluctuate depending on the production level. So this marginal costing is a technique to ascertain the cost used in any particular method of costing by differentiating the difference between the fixed and the variable cost. So it is the cost of a marginal unit of producing an extra unit or an additional unit. So the unit may be article or a batch of articles. So what is the definition of marginal cost? So marginal cost, so the cost of any unit production is the increase in the total cost to which the firm becomes committed by the production of that unit. But if one part of the total cost is fixed, this part will remain unchanged. As output expands, only the variable cost will increase. So the production, the increase in the unit of production. So ultimately, if one part of the cost is fixed, so the other part will become variable cost, which will increase. So what is the features of marginal costing? So the first one is segregation of cost into fixed and variable elements. So in marginal costing, all costs are classified into fixed cost and variable cost, and marginal cost as product cost. So only marginal, that is variable cost, are charged to products produced during the period, because the other cost becomes fixed cost. So the product produced, okay, that cost is equal to your marginal cost. Fixed cost as period cost. Okay, fixed costs are treated as period cost, meaning to tell for an entire month you will pay a rent, so that becomes a fixed cost, so the period cost, and are charged to the costing profit and loss account of the period in which they are incurred. Value of inventory, the work in progress, and finished goods are valued at marginal cost only. And the contribution is nothing but it's the difference between the sales value and the marginal cost of sales. So the relative profitability of products or department is based on a study of contribution made by each of the products or department. So it is nothing but, contribution is nothing but the sales minus your variable cost. Pricing, in marginal costing, priced are based on marginal cost plus the contribution. So the value of extra cost plus the contribution. So let us look into these sums. So what is the meaning of fixed cost? A cost which remains unchanged. Variable cost is something that will change according to the level of production. So when does it becomes unchanged? When it is calculated for per unit. So semi variable cost not necessarily either fixed or variable but are semi variable. Example, your supervisor salaries. So first let us look into few problems. So it is evident from the marginal cost equation that contribution is excess of sales over the marginal cost of sales. So this is also known as gross margin or the contribution. So sales minus your variable cost or sales over your marginal cost of sales is nothing but your contribution. So this is basically known as the gross margin or the profit margin or the cost margin, which first meets the fixed cost and excess over the fixed cost, which represents a profit. So contribution is nothing but like a profit. What is the profit that you gain from your marginal unit of production? So our first problem, direct material is 20,000, direct wages is 5,000, variable factory overheads is 3,000. So your they have totaled it and they have given 28,000. We have a variable selling and distribution overheads which is 7,000. So you get 35,000 as your total variable cost. They have given sales 60,000 and they have given fixed cost 20,000. So your contribution is nothing but the formula to calculate contribution is sales minus variable cost. So sales is 60,000 minus your variable cost is 35,000. You get 25,000 as your contribution. So contribution minus fixed cost is your profit. So 25,000 is your contribution minus your fixed cost, which they have given in the question, 20,000, so which is nothing but 5,000. So this can be calculated in the same table itself, like sales minus variable cost is equal to contribution minus fixed cost is equal to profit. So it can be calculated on a stepwise, or if you want to calculate the contribution, so fixed cost plus profit is equal to contribution. So fixed cost is what? 20,000 plus 5,000, which is 25,000. So this is just like a proving method. So in order to find out whether it equates, it will obviously equate. Uh, you're just moving your left hand side items to your right hand side. So fixed cost, when fixed cost moves towards your left hand side, become fixed cost plus profit is equal to contribution. So 20,000 plus 25,000 to 25,000. So moving on to our next concept, which is cost volume profit relationship. So in an organization there are three factors which is very important. One is the cost in producing the product. Okay, the second one is selling price of the product, so that is nothing but sales of the product, the volume of sales. And the third one is what is the profit. Okay, what is the profit gained from the product. So basically we are concentrating on cost volume profit relationship. So how do you basically analyze your profit? What all is required to analyze one's profit in an organization? It first depends on the cost of producing the product. So second, we look into what is the selling price of the product. Does it include the profit margin? Okay, so when it is sold, how much of volume is sold? So these three factors tell us what could be the profit of an organization. So these three are very interdependent and have a very close relationship. So what we assume in this analysis is the per unit selling price remains constant. Every product cost will remain. I mean, every product selling price is very common and very constant. Okay, so for example, you buy shampoo, the shampoo value will remain same. Okay, for example, there is Mira shampoo, It is 3 rupees. So every packet of Mira shampoo is 3 rupees. So the per unit selling price remains constant. Second one is fixed cost remains constant despite wide changes in the level of production. So the fixed cost remains constant. Whatever is the value of production, it will remain constant. That's what we assume. Only when you assume this, we can understand the concept. Okay, understand this relationship through our formulas. Next is the variable cost per unit remains constant. So, for example, the variable cost of 50,000, okay, the variable cost of 5,000 units is 50,000. Okay, so at that time, what is the variable cost of per unit? Okay, so it is nothing but 50,000 divided by 5,000 units, so 10 rupees. So this 10 rupees variable cost per unit will remain constant. Okay, so this is our three assumptions. So we'll look into how are we going to basically calculate our cost volume production relationship. Okay, so a simple statement showing cost, volume, profit relationship. So we start with sales units, which is 5,000 for 50%, 70% is 7,000, 100% is 10,000. So for example, you just assume that they have given for 50%. Okay, the value is given for 50% and they have told us to calculate for 70% and 100% of output. Okay, so in that way I will calculate it and basically show you. Okay, so the selling price per unit they have given it is 1.25. So what would be the selling price for 70%? It is 1, and the selling price for 100% is 0.80. Okay, so the total sales value is 5,000 into 1.25, which is 6,250. 7,000 into 1, 7,000. 10,000 into 0.8, 8,000. Now we look into direct materials. Okay, so the direct materials, which is 2,200 and 2,400 for 70% and 2,600 for 100%. Direct wages they have given it 600, 700 and 800. Total variable overhead 800, 1,000 and 1,300. So the total variable cost will be B, which is direct material, direct wages and total variable overheads. So which we get 3,600, 4,100 and 4,700. So how do we calculate the contribution? Now we have the sales value, we have the variable cost. So the contribution will be sales minus variable cost, which is A minus B, 2,650, 2,900, 3,300. Now the total fixed cost is 1,500, 1,500, 1,500. Why do we tell this is 1,500? It is fixed. Okay, so it's a fixed cost. The total cost will remain fixed. Okay, now profit. The formula already we know. Contribution minus fixed cost is profit. So 2,650 minus 1,500, which is 1,150. 2,900 minus 1,500, which is 1,400. 3,300 minus 1,500, 1,800. So the profit or loss percentage is nothing but profit divided by sales value into 100. So 1,150 divided by 6,250 into 100, which you get 18.4%. 1,400 divided by 7,000 into 100, which you get 20%. 1,800 divided by 8,000, which you get 22.5%. The next we are moving on to profit volume ratio. So profit volume ratio is the ratio which is tells about the relationship between the contribution and sales. So it basically talks about the relationship between the contribution. It established the relationship between the contribution and sales. So it is another method used to calculate the cost volume profit relationship, which is the PV ratio. So how do you basically calculate your cost volume profit relationship? It is nothing but your PV ratio. So it helps in studying the profitability of the operation of the business. So basically the ratio is equal to contribution divided by sales into 100. Or how do we calculate contribution? Sales minus variable cost into 100. Or there's another formula in the first illustration we did, right? Fixed cost plus profit is equal to contribution into 100. So these three formulas will be used depending on the information given. So first problem is sales. They have given 8 lakhs, variable cost is 3 lakhs, fixed cost is 2 lakhs. So calculate the PV ratio. So PV ratio is equal to, if you see they have given sales and variable cost. So your contribution will be what? Sales minus variable cost. Okay. If we take fixed cost, we need to calculate our profit. So we'll directly take sales minus variable cost divided by sales into 100. So sales is 8 lakhs minus 3 lakhs divided by 8 lakhs into 100. So 8 minus 3, 5 lakhs into 100 divided by 8 lakhs, which is 62.25%. Okay. Or we can use the next formula also, fixed cost plus profit divided by sales into 100. So for that, first we need to calculate the profit, because they have given only sales, variable cost and fixed cost in the value. So sales minus variable cost minus fixed cost, nothing but a profit. So 8 lakhs minus 3 lakhs minus 2 lakhs, which is nothing but your profit, which is 3 lakhs. So fixed cost is 2 lakhs plus profit is 3 lakhs divided by 8 lakhs into 100. Therefore PV ratio is 5 lakhs into 100 divided by 8 lakhs, which is 62.5%. So irrespective of what method we use, we will get the same value. So next we're moving on to break even point. So it is a point where there is no profit nor there is any loss. So it is a point of no profit or no loss, and at this level firm is said to be break even. So under equation method, the equation method centers on the contribution approach to the income statement. So the format of the statement can be expressed in equation. So basically there are two equation. One is profit is equal to sales minus variable cost minus fixed cost. So sales minus all the cost is equal to profit. Or sales can also be expressed as variable costs, variable expenses plus fixed expenses plus profit. So when you're moving this analysis, basically when you're moving the formula from right hand side to left hand side, in order to make sales as unknown figure, you get the same balances. So the following equation is known as basic marginal cost equation. So if profit, sales minus variable cost is equal to fixed cost plus profit. Okay, if there is a loss, it is sales minus variable cost is equal to fixed cost minus loss. So contribution is when, how do you find out contribution when there is a loss? Fixed cost minus loss is equal to contribution. When there is a profit, fixed cost plus profit is equal to contribution. So let's look into our next problem. So given sales is 10 lakhs, variable cost is 7 lakhs and loss is 1 lakh. Okay, find the fixed cost. So sales is equal to what? Fixed cost plus variable cost minus your loss. So fixed cost is the unknown figure, so you put it in your left hand side. So is equal to sales minus variable cost plus loss. Okay, If you see here, sales they have given 10 lakhs, variable cost they have given 7 lakhs, loss they have given 1 lakh. Okay, so sales is equal to fixed cost plus variable cost minus loss. So fixed cost is equal to sales minus variable cost plus loss. So when you put it in your left hand side, the unknown figure, so is equal to sales is 10 lakhs minus 7 lakh plus 1 lakh, which is 11 lakhs minus 7 lakhs, which is 4 lakhs. Or you can do it in a different method also. So if you see, sales they have given 10 lakhs, variable cost 7 lakhs, so we can use this method. So sales 10 lakhs, variable cost is 7 lakhs, so contribution will be sales minus variable cost. So 10 lakhs minus 7 lakhs, which is 3 lakh. So they have given loss to be 1 lakh. Okay, so if there is a loss, you will add it. Okay, fixed cost plus loss is equal to contribution. Okay, if it is a profit, sorry, if it is a loss, you will minus it. Fixed cost minus loss is equal to contribution. If it is a profit here, then it will be fixed cost plus profit is equal to contribution. The same formula which I have told. Okay, contribution is fixed cost plus profit, contribution is equal to fixed cost minus loss. So 3 lakh we have, 1 lakh we have. So what is your fixed cost, which is 4 lakhs. Okay, how do you get this? Basically, contribution is equal to fixed cost plus loss. So the unknown figure here was fixed cost, so it will be contribution plus loss. So 3 plus 1, which is 4 lakh. So moving on to our next question, which is variable cost is rupees 50,000, fixed cost is 30,000, profit is 10,000. Calculate the amount of sales. So we'll use the same method. So we have sales to be how much? Sales they have not given. So whatever they have given, just put it in that table. Okay, variable cost is 50,000. So variable cost is 50,000. Fixed cost is 30,000. So fixed cost they have given 30,000. Profit is 10,000. Here we have a profit, which is 10,000. Okay, so contribution will be what? Fixed cost minus profit. Okay, fixed cost minus profit is contribution. Sorry, fixed cost plus profit is your contribution. So 30,000 plus 10,000, which is nothing but 40,000 is your contribution. So what is your sales? Sales plus variable cost is equal to contribution. So if you reverse the formula, it will be sales is equal to variable cost plus contribution. Just the finding out the unknown figure. So it will be 50 plus 40, which is 90,000. Okay, so you get your sales to be 90,000. Okay, so moving on to next question, which is sales is 1,50,000, profit is 40,000, fixed cost at 30,000. Calculate the variable cost. So we'll do it here. So what all unknown figure they, what all known figure they have given? Sales is 1,50,000. 1,50,000. Profit is 40,000. So profit is 40,000. Just with that unknown figure, you can just find it out. Okay. Fixed cost is 30,000. Cost is 30,000. So fixed cost is 30,000. Profit is 40,000. So your contribution will be, they have given fixed cost, you have the profit. So contribution is fixed cost plus profit, which is 30 plus 40,000, which is 70,000. So if you see they have given sales, we have the contribution. So can we find out the variable cost? So the actual formula, sales minus variable cost is equal to contribution. Here unknown figure is variable cost, so it will just reverse the formula. So sales minus contribution is equal to variable cost. So 1 lakh minus 70,000, which is equal to 80,000. Okay, so are we getting the answer? Yes. So moving on to the next question, which is from the following particulars, calculate break even point. So first, looking into the formulas, break-even point for output is total fixed cost divided by contribution per unit. Break-even point in sales is total fixed cost divided by PV ratio. So from the following, calculate the break-even point. So they have given fixed cost, variable cost per unit they have given, and selling price per unit they have given. So we are supposed to find out the contribution per unit in order to implement the formula. So break even point in units is equal to fixed cost divided by contribution per unit. So fixed cost divided by selling price per unit minus variable cost per unit. So selling price is what? 8 minus 5 is equal to 3. This 3 is nothing but your contribution. 60,000 divided by 8 minus 5. So 60,000 divided by 3, which is 20,000 units. So break even point in sales formula is fixed cost divided by PV ratio. So how do we calculate the first we need to calculate the PV ratio. Formula is sales minus variable cost divided by sales into 100. So 8 minus 8 into 100. So 3 into 100 divided by 8, which is 37.85%. So now you implement your break-even point formula, which is 60,000 divided by 37.5%. So 60,000 into 100 divided by 37.5, which is 1,60,000. So your next formula is margin of safety. So what do you mean by margin of safety? Margin of safety represents the amount by which volume of sales exceeds the break-even point, and the actual output represents the margin of safety. So higher the margin of safety, better for the business, because it indicates that even if there is some fall in the sales, still the firms will earn profit. So low margin of safety represents a difficulty in business position. So obviously it is nothing but the amount by which the volume of sales exceeds, okay, exceeds beyond a certain point. So that till that person, if it exceeds beyond that, you will get a profit margin. So that is what is the assumption. It is a profit margin kind, the borderline of profit. Margin of safety is equal to profit divided by PV ratio. So your next illustration, they have given fixed cost, they have given profit, and they have given sales. Calculate the margin of safety. Profit is 90,000, sales is 5 lakh. Calculate margin of safety. So margin of safety formula is profit divided by PV ratio. So for that, first you need to calculate your profit. So profit PV, so first you need to calculate your PV ratio. PV ratio is equal to profit plus fixed cost divided by sales into 100. So 90,000 divided by 1,50,000 divided by 5 lakh into 100 into 100. So 2,40,000 into 100 divided by 5 lakh, you get 48%. So margin of safety is 90,000 divided by 48%, which is 1,87,500. So moving on to our next problem. So fixed cost is 1,20,000, variable cost is rupees 3 per unit, selling price rupees 7 per unit, and output is 50,000. Determine the profit under each of the following situation. With the above data, with a 10% increase in output, with a 10% increase in fixed cost, with a 10% increase in variable cost, and with a 10% increase in selling price. So first is situation they've given is with the above data, you're supposed to calculate what the profit. So fixed cost 1,20,000, variable cost 3 per unit, selling price 7 per unit. So profit at the output of 50,000 units. Okay, so with the following data, so what is the formula to calculate your profit? Contribution minus fixed cost is equal to profit. Okay, so contribution per unit is selling price per unit minus variable cost per unit into the number of outputs. Okay, so selling price per unit from the above data is 7 minus 3 into 50,000, which is 2 lakh, less fixed cost which they have given in the question, 1,20,000. So profit is 80,000. So your next situation, what they have told is increase in output with 10%. Okay, so 10% increase in output is nothing but 50,000 is your actual output. So 50,000 into 10% increase, so it is 5,000. So 50,000 into 10 per divided by 100, which is 5,000. So 50,000 plus 5,000, 55,000 is your increase in the output. So contribution we already found out, it is 4 per unit. So in the second situation nothing changes, only the output changes. So 4 rupees into 55,000, which is 2,20,000. Select fixed cost, which is 1,20,000. So profit is 1 lakh. So in your third situation, increase in fixed cost at 10%. So contribution is 2 lakh, fixed cost less fixed cost is what they have told, increase in fixed cost they have told. What was your earlier fixed cost? 1,20,000. So 1,20,000 into how much percent have they told increase? 10%. So into 10 divided by 100. Okay, so you get 12,000. Okay, so 1,20,000 is your actual fixed cost plus increase 12,000. So your fixed cost is 1,32,000. What was your actual input in the beginning as per the data, which is 2 lakh. So 2 lakhs contribution minus fixed cost is 1,32,000. Profit is 68,000. Next is increase in variable cost 10%. Now they have told variable cost increases by 10%. So what was your earlier variable cost as per the data? Variable cost was 3 rupees per unit. So 3 into 10% increases, 3 into 10% is 0.3. So 3 plus 0.3 is nothing but 3.3 is your new variable cost. So per unit is equal to selling price per unit minus variable cost per unit. So 7 minus 3.30, which is 3.70. So total contribution on 50,000 units is 50,000 into 3.70, which is 1,85,000. So less fixed cost, which is 1,20,000. So profit is 65,000. So increase in selling price is 10% they have told. Now you are supposed to calculate selling price per unit. Selling price was 7 rupees earlier. So 10% increase will become 0.70. So 7 plus 0.70 is 7 into 10 divided by 100 is 0.70. So 7 plus 0.70 is 7.70 is your new selling price. So contribution per unit is equal to 7.70, which is your selling price per unit, minus your variable cost per unit is 3. So therefore it is 4.70. So total contribution of 50,000 units is 50,000 into 4.70, which is 2,35,000 less your fixed cost 1,20,000. So you get your profit to be 1,15,000. So the next problems will continue in the next video. Thank you.